right, so I think we have a pretty good sense of what's driving the market reaction between how we closed yesterday and then how we traded today. The markets are very in tune with what's going on with those stimulus discussions. So with today's move, we didn't quite get back up to yesterday's high before the infamous tweet came out, but we've made a pretty good dent in that, especially with the small cap. So I'm going to break down, this great small cap performance and this, and what have we seen in the past when small caps, especially in the recent past, when small caps have really performed strongly, not just on an absolute basis, but on a relative basis. And what does that suggest going into the next few weeks? And how does the next few weeks compare to 2016, the few weeks into expiration and a couple weeks after expiration as we head into the election cycle? And what could that mean for volatility and how the market's expected to perform? So I'm going to break all that down, and then our trade idea takes a look at a stock that has its own nice little bullish pattern, or a little bit of a reversal pattern to the upside that may have already experienced all of its volatility in the past month or two. So let's go ahead and get started. Today is Wednesday, October the 7th, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's go ahead and start off taking a look at the S&P 500 with the market forecast indicator. You can see the nice little rally we had today, recover basically what we lost yesterday afternoon. Got us up to the high point of yesterday. Got us back above the moving average, turned it yellow. It's not rising yet, so it's not dark. It's not green. We don't have dark green shading in behind because we're not above 50 yet on the intermediate line. But you can see kind of how we're getting there. You notice, this, like when you get these nice strong intermediate runs, when you got the weak posture and you're turning strong, you get these kind of strong bullish moves on the near term line. We kind of got one there, lasted a couple of days, and then we've been grinding down at some smaller levels where it's below the market sentiment. Over here, we were obviously well above the market sentiment line. And then over here, we were a little bit below it. In fact, it almost looks like kind of like this type of pattern where the market sentiment line was falling and the near-term line got up to around just above it and then came back down. Obviously, I don't think we're going to have a COVID-type move here. But it makes you wonder about how strongly bullish this move has been. Obviously, from a short-term perspective here, when you just look at the Fibonacci on a very, very short term, we are into the retracement zone and we're stuck in it right now. We're, get through the 68 and here we go, 34, 46, and, we're through the retracement zone on this short term move. But as of right now, we're just kind of stuck in the middle and using yesterday's high as a resistance level. Near term line falling, momentum line swinging back and forth with one extreme move to the upside, followed by multiple, sandwiched in between multiple extreme moves to the downside. So that's kind of why we're unable to really get going here from a S&P perspective. The Dow actually does, and also does not have the strong near-term move to really cement this new intermediate rally. And again, a little different from over here because the market sentiment line was so low that the near-term line was up above it. Here, the near-term line is barely able to get above, not just in the reversal zones, barely able to stay above market sentiment line. And we have, of course, the crossover above 50. That's what gives you the dark green shading. You can see here we're fluctuating on the NASDAQ as bullish as it's been. You can look at that momentum line up and down, up and down. The NASDAQ's really kind of going flat and sideways here. And then unable to really get a good trend going one way or the other because you're not, you don't have, extended moves of dark pink shading and red lines, but you also obviously don't have this yet, which the Russell does have. The Russell does have the only one so far that has the dark green shading and the green line for multiple days now. The Dow just getting it today, and its intermediate line has crossed above its market sentiment line. Its near-term line made a good run up into the upper reversal zone, and obviously a good move tomorrow. Would probably, get you, depending upon how much the near term and momentum line bounce up, might end up getting you an overbought cluster, just like that, on the Russell. So it's been a very nice run coming off this oversold cluster on the Russell 2000 to bounce back up towards 0%. We're actually moved the 0% line higher here from this peak that I had earlier, the first one and the only one. But also keep in mind that it's got more room to do this because, like again, if you look at where we go, during this pullback, it pulled back down to the 62% retracement of this decline over here. The Nasdaq 100, during its pullback, there's the 62% retracement of its decline way down here at the bottom. So that's how much, again, room the Russell has to move up. The Russell, out of all of these, the Dow is still a little bit below. The S&P is trading slightly above its, I just need to zoom out. It's trading slightly above its pre-COVID high point. The Dow is just a little bit below it. The Nasdaq obviously way up above it, and the Russell 2000 also below it. So there's room for some catch up here for the Russell 2000, and that's what it's doing. And as I mentioned before, previous strong moves on the Russell 2000, that kind of catch up type trades on the Russell 2000 has led during this bullish market to periods of volatility. There's that move that led to sideways action before the volatility. So, when you get these strong bullish moves in the Russell, especially on a relative basis, it usually hasn't led to, a strong trend in a significant rotation. It's usually led to, some eventual selling. And that seems to be what we're getting right now. All right, before we look at some other charts here, I invite you to subscribe to our YouTube channel. Mouse over this icon right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when these videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us two things. You liked our video today, and you want us to do another one again tomorrow. It's a quick way to give us feedback. If you don't like our videos, of course, you don't have to click on anything. But if you do like our videos and you want to let us know, give us a click right there right now while you're watching. That will let us know you want us to keep doing these. Also, while you're down there, comment. What did you get out of our video today? What stood out to you? What light bulb moment did you have? What questions or comments do you have? Post those in the comment section. Join our website at marketscholars.com. There's a link popping out there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content in between the videos from day to day. There's my handle up here at DavidSettle42. And join our Market Outlook Facebook group that we've created. If you're watching us on our blog here, I invite you to check out some of these other things here on the right. Our Market Outlook live video where I review all the old trade ideas we do in all these Market Outlook videos, as well as I put on today's trade idea already before the market closed today. So we do that every day at every day I do the Market Outlooks. I do one of these at 3:30 Eastern time to manage all these options trades for the most part that we've been doing. You can see our lineup of all of our upcoming events. Again, our monthly subscribers, our plus subscribers, as well as our premium subscribers, they all get access to both of these, our Market Outlook Live, as well as all of our trading rooms. Our premium subscribers get access to our Q&A sessions, as well as other premium resources here, and then access to our class communities, which include our custom content that we share with our premium subscribers. If you come down here to the bottom, click on this heart that opens up a new window. Hit that like button right there. Also hit this thumbs up icon. Also opens up a new tab. You can click on this like button right here for today's Market Outlook post. Again, the more you do that, it benefits us because Twitter and Facebook will promote our content to all of our followers that are following these, more than just 158 people. It also benefits you because Twitter and Facebook will promote content in your timelines from the accounts that you engage with the most. We try to make it really easy for you to engage with us here. All right, taking a look at the Hakinyashi candle, and after getting last week's kind of transition candle, here we go this week, higher close, no lower shadow, higher high, as well as a rising 50-day moving average and 200-day moving average, and the PPOs turn back up. So that's a pretty decent little jump. Remember, getting up to above that 68% retracement means we're able to really get through and get going again. So we're kind of still in that Fibonacci retracement zone here, but you can kind of see we've got a good little reversal pattern, especially on, of course, the Russell 2000. Look at that good bullish. After we did get a transition candle, a good bullish breakout type candle there, with rising momentum. That's that's not nearly as far along as, like, say, the Nasdaq 100 is, which is still kind of figuring it out, right? We don't have a higher high in the Nasdaq 100. We barely got a higher close. We're really close to getting an actual lower shadow, and PPO is still falling. So that's, you can see where the strength is, and the reason why the strength is there is because we've got a lot of room to run. I mean, this is where the Russell's at compared here. Let's go to 5 years to that 2018 high point right there in the summer, late summer, fall, September 2018. You look at the NASDAQ 100, and here's that same high point right there. Get rid of this here. Here's the same high point there on the NASDAQ. So the NASDAQ has blown that out of the water. The Russell 2000, not so much. It's still figuring it out. It's not only below its pre-COVID high, but that pre-COVID high was below that 2018 high. There's a pre-COVID high compared to the 2018 high, and then we're even higher than that. So that's, this is the leadership, and I expect that it will continue to be the leadership. But just know that when the Russell is leading and showing really good patterns, and the others aren't, then it's doing a catch-up similar to what we've seen before. And if you take a look at like the DMI pattern, for the S&P 500, that's not a bullish pattern there. You look at the RSI and the CCI for SPX, you are above 50 and you're barely above 100, but we're not really strongly bullish here. And obviously not nearly the same as we are on the Russell 2000, which is above 60 and is above 160 there. You look at its DMI for the Russell, and you can see here, let's do IWM, keep it with SPY, and you can see we are up above 25 and the negative is well below. The ADX, though, is still very, very low, still well below 20. So it needs to really kind of get going to get into this dark green shading again. And again, last time we had that, we saw what happened. Right, it ended a period. I mean, here's our spikes. This is our spike that we've had in the positive DMI and the Russell, and every spike that we've had has led to a weakness. Here's our spike currently, and it's the smallest spike out of all of them. And we'll see, when this is eventually done, if it leads to weakness like the other three. Let's take a look at the 3 green arrow chart for the S&P 500. We obviously have 3 green arrows. Again, we're kind of fluctuating. When we get lots of arrows, that's usually a reversal sign, more of a reversal sign than what we've already had. So keep that in mind. If you look at the 2-line version, we are back above the 30-day moving average. The 8-day is above the 17. That's why the MACD is green. We have a rising histogram. The orange, the average is still below 0. Stochastics is getting up there. It's easily above 60, working its way towards a reversal zone. But neither the green or the 8 or the 17 are back above the 30 yet. So, again, kind of goes with this idea that we have to kind of break through at least this 343 level, but also get out of that Fibonacci retracement zone before we can really feel good about, okay, we're reversing. Now we're coming up off a higher low, and we can expect now to move up to a higher high point, especially when you consider that was such a parabolic high point. It's not going to be easy to get up to a higher high point. And also when you're in this volatility environment right now. Now, if you take a look at the intraday chart, you can see why, we have some, there's the old high point here. We have some volume up in this area, that 340. We've talked about the 340 as we were kind of approaching these areas as a place of resistance, especially when you look at a longer term here. Let's go to like a 90-day chart. You can kind of see, that's where this volume node runs out. Once you get above here, and remember, that's where that retracement zone ends too, the top of that retracement zone. Then it's away we go. But you can see why we're kind of still struggling in this area where there's a lot of volume and some resistance. And you can also see too, if we were to get down, filling in today's gap and then and yesterday's gap and finish filling that in, there's not very much volume below that, and it's a very easy drop down towards these lows again. And then eventually down to the 78% retracement, where I think that's kind of like the worst case outcome as we get into this area with maybe a touch down to the 38 on an intraday basis. That's a little different than the Qs. The Qs are a little different in that, again, you break through this point of control, there's not a whole lot of downside to its 38%, much less down, to its pre-COVID high. There's a little bit of a volume there. So that's why, it's got, a much poorer margin of safety. Look at the Russell 2000. It has gotten a new 90-day high point, much less 4-week high point. And you can look at all this volume it has below us. So, it's not going to be as easy for it to come down. It's got very, little path of least resistance to the upside. And if it does start to fill in these gaps here, these relatively common gaps, it won't, it's not going to be, it's going to be a grindy move. So I don't expect us to fall, off the elevator or escalator or whatever the analogy is, or fall out the window. We're not going to drop sharply. We'll get some downward moves. We'll get some volatility for sure. That's why the VIX is as high as it is. That's what the market's expecting. But don't expect COVID type drops, or I know we get so preconditioned to when the market goes up, it goes up every day, and when it falls off the table. And that's just not the reality for most intermediate pullbacks. So the reality for most intermediate pullbacks, and it looks like to be the case of this one, is we grind our way towards support level until we find a good one, and then we bounce off of that. In this case, there's your 23% retracement. Actually, it needs to be moved up a little bit higher. We'll move this up to now the 161 high, but there's your 23% retracement. There's your 38. So more than likely, we're going to get down to this 62%. I mean, this is about all we'll probably get down to. There's a point of control there before it finds some support. By the time this is all said and done, and then we start a new intermediate trend, most likely after the election. Let's take a look at the volatility index, and you can see why I say that, because, again, the volatility, not only is it above 20, which when you're above 20, the market's buying protection, right? So not only are we above 20, we're above 25. We're in the upper 20s. We're close to 30. And volatility has been gradually moving higher here. We're into this neutral zone now. I expect that we'll continue to gradually move higher until we get up to 100, 105% at the worst of this pullback. But that started here. That's kind of continuing through some ups and downs all the way till now. But this isn't going to be your typical spike up in volatility to 105%, and then we kind of grind our way as it fiddles around with a new low. No, we've been gradually moving up, and volatility is still high, and the market's still concerned. So we're not out of the woods yet. If we were breaking below 20, then we'd feel really good about potential new intermediate run starting right now. But the reality is we're not. And not only are we not there, but if you look at today's volume and trading range, volume at 56 million, the trading range, 3.5 points, but you have to include the gap here. So we closed at 334.93. The low was at 338 today, so over 3 points. So we were actually over the ATR when you include the trading range, the overnight trading range. So when you look at it from that perspective, we're still getting close to 2% moves on ATR. That's not bullish. Bullish is getting below 1% moves, like getting 3-point moves to the upside, and that's it. I mean, you look at this move here, and you can see these are strong bullish moves. They're not necessarily offsetting strong bearish moves, and the VIX is still well above its historical volatility level. So, we're not out of the woods yet here. We're not going to get the big spike to the downside. As I've said before, there's lots of spikes to the downside, and then we kind of grind, and spikes to the downside, and then we kind of grind. Big spikes to the downside, and then we grind. We're not going to get that. We've had our spike to the downside. We've been grinding. And we've had a little bit of at the beginning of this run, a little bit of some negative momentum, but then that was it, right? And we're just going to kind of continue, especially with the historical volatility still well below implied, as high as implied is, which is kind of rare for that to happen. So with that still below, that just means, it's going to be kind of, some up and down moves to the downside, and it's not going to be this kind of one hurrah. The worst of it, as we saw, I showed you on the DMI before. But if I go back, a few years to this 2019, the worst of the selling, you can see the DMI negative got up. Instead of getting up to its worst at the beginning and then grinding through, it got up to its worst level at the end. See over here, it gets up to its worst level at the beginning, and then grinds through until it figures out that low. At the beginning, it grinds through. Got a little bit of one at the end as well. This was at the end. This is what I think that this is our current pullback is like. So we haven't had much of a jump, similar to the initial pullback that started in May 2019. I think we're going to get that kind of move going into the election, and we did kind of get that type of move in November 2016. You can see We started to get a little bit of a grind, but not very much, and we got the worst of it right before the election. I see something very, very similar happening now. It wasn't a huge fall off a cliff. It was a grinding move towards the election. Once we got through the election, then we were able to get going with a positive direction again. I very much expect the market to do something very similar to this go around. But it might not be the night after the election this time. It might be a week or two or a month after, depending upon how long the result potentially drags itself out. All right, so before we look at some other things here, just to summarize the technical outlook, the posture is kind of bullish here in the short term, more so for the Russell 2000, which has got a really good intermediate bullish posture. But we've seen outperformances by the Russell in the past that hasn't led to a new rotation to a new sectors in the market. It's usually led to volatility. And considering the seasonality and considering the election coming up, it's very likely we get a period like that again over the next so many weeks as we head in towards early November and potentially through early November. So it might be kind of like one little catch-up trade, like others we've seen in the past few years in the Russell 2000. It's kind of showing us before we get our biggest volatility move over the next, especially after, as we get through October expiration. That's probably where volatility will really start to ramp up slowly, not falling off a cliff, but slowly ramping up to potentially its worst levels right at the election. And then more than likely a new intermediate trend starting once we get the result from there, once we're through the biggest uncertainty we have, and we start getting more news on the vaccine front and more news on the stimulus front potentially, and more news, and with all the other technical tailwinds that are behind the market, willing to push it up over the long term. I don't see that starting in the next week, or even with this move right now on the Russell. I don't see this the beginning of the intermediate run. I see that we're still a few weeks off from that. So what do you think? Do you agree with that? Do you disagree with that assessment? Let me know in the comment section below, especially if you disagree, and let me know why. What do you see? What charts are you looking at that suggests either you're a lot more bullish than I am already right now, or you're a lot more bearish than I am, that you think there's a lot more room to fall than I do? So let me know down there below. All right, if you take a look at the chart, you can see that performance on the small cap. And again, we saw that before, and we've seen that actually multiple times before. Let's go to the 9 months. We've seen the small cap index here make that type of move here. Let's just go from March 23rd. March 23rd here. From that low point going forward, we've seen periods of time where small cap index really took off. It's kind of languishing here, and then boom, it popped up. And there's other times right here, boom, it popped up, and that was the period of underperformance. It was underperforming, and it rallied up to outperformance and dropped. It was underperforming, it rallied up to outperformance and dropped. It was underperforming, it rallied up to some underperformance, and then it's kind of dropped. Now it's really pulling away from the S&P again and catching up finally to the Qs. See, over here it caught up to the Qs and broke through. Over here it caught up to the Qs and broke through. Over here it got up to the Qs, and that was about it. Again, since the low point, right? Over here it's catching up. There was quite the gap here between the IWM and the Qs, and now that gap is getting really small. So we might, maybe over the next week, we might shrink that gap even more, similar to like that last push there. But then we've seen in the past, I don't think the Qs will take off from there. But we've seen in the past where, like during this period of time, the Qs stayed flat down a little and the Russell pulled back. And so there might be some underperformance there as the Qs get back up to this level. So if you just take a look at just today here, and actually let's look at this week since the week started. We'll go 15-minute chart. And, there's that strong performance in IWM up over 4.5%, where the market's up 2%, the broader market's up 2%. Emerging markets outperforming as well, with commodity prices doing very strong. Those two have a little bit of a link together, obviously. But look at the move down in small and long-term bonds. That is significant, right? Because we keep a close eye on long-term bond prices. We know that that's one of the major tailwinds for the broader market going forward. And look at that breakdown we've had this week. on long-term bonds. Breaking down below that point of control into a big volume gap, and then there's your breakout on the yields, breaking up above the upper band. We've done it before. We've had a couple other periods. There was that catch-up period where the Russell did really well, and a little bit of one here too in August, and we kind of stayed down since then. So here's another period. There's that initial period there too. But here's another period of breaking up above the upper band and potentially up above here. Let's look at the Keltner channels too. Yeah, up above the Keltner channel as well, with the band starting to move out. So there's an opportunity for a little bit of a breakout. But again, we did that before. We've done it here. We've done it here. Are we going to get that kind of move again on that same kind of period of volatility that came after both of those jumps that we saw before? There's commodity prices. You can see there, they haven't really pulled back very much during this decline that we've had in equities. They're still kind of up at this level, easily inside their Bollinger Bands. And if you look at where it's got to get to really get going, there's DBC. You can kind of see this high point that we have. We kind of need to break above that level for us to get into another area, some gap in volume here. And there's all this, as we move on, all this volume is going to be coming off. So this, I'm going to venture to guess that this orange line will move down towards this top. So by the time we do break through there, we're going to be breaking out of the value area into a pretty significant gap in volume, with only a little bit left over here, depending upon how long that takes. So we're not in the upper quartile. This isn't a strong move. We are at least up above again this week, above the point of control. So it's a positive sign. It's better to be on the upper side of that in the value area than be on the downside. But it's going to act as a gravity pull to keep it down until you can break out of that value area, which, like I said, in a month or two, by November expiration, potentially, that orange line, the top of the value area, might be down there at this point, in which point we will be, or could be, up above it and have a much better chance of getting going. And remember, that's a reflection of economic growth expectations, inflation expectations as well, and also would be a sign, with the rising yields, it would be a sign. Where's that yield curve chart? Right here. After this kind of bear market, this stealth bear market that we've been in, reflected by this drop in yield since the fall of 2018. Remember, it started internationally with equities, with foreign stocks in early 2018. It peaked here in the U.S. with all of our asset classes in the fall of 2018, and then we had our bear market. We don't think we've been in the bear market because those FANG stocks have held us up very well. But now we got down to this level. This is a significant tailwind for equities. So once we get through this period of volatility and yields can really get going to the upside, remember, look how big the yield curve got, at its highest point. So we've got lots of room for this yield curve to continue to work its way up to the upside, to get up to this 2% level or higher, 2 to 3% range, before the Fed really even has to. I mean, look how long it stayed up. From 1.5% up to 2 3/4, the gap between the 2 and the 10 and the 2-year, while the Fed kept rates at zero. So the Fed doesn't have to raise rates for the yield curve to get going to the upside, and that's very bullish for the markets when they're moving up in that direction like that. So we'll kind of keep our eyes peeled for these bullish moves, these really good bullish markets that lead to that type of move, and these types of moves coming off of these bearish markets where you have these significant declines. All right, if you take a look at how things have been performing here over this past week, I remember utility. I think I shared with, at least in my classes, I shared. Let me show you here. I can't remember if I showed you on Friday or not in the market outlook. But since the, I don't know why I did that. You can blame Charles Schwab for this now, right? But since the low point that we had here, since the low point, you can see utilities and real estate and financials have been the biggest winners, all the way up to that before Trump tweeted out about the negotiations there. They were the big one. That's not your typical bullish leadership to have those, especially all these interest rate sensitive areas that are typically sensitive to interest rates in opposite directions, all moving up together. And then you can see communication services really lagging. Technology had been outperforming, but since then is not above these highs. The communication or discretionary doing a little bit better in that perspective, and you can see some other consumer stocks underperforming. Of course, with the issues that Google and Facebook are having, that's why your communication services are underperforming, as well as media companies for that matter. So you have, that's not the best leadership per se. So now when you look at, okay, well, how about this week alone? How are we doing here? And you can see again, materials and energy are up. Real estate pulling back a little bit, but utilities are still up there. Technology is doing great, but communication services still down. Discretionary and staples, consumers still down. So again, not the best leadership here, even this week alone. Energy being the big winner for most, and up until the tweet, right? Materials and energy were the big winners, along with utilities and financials. So it's like, I don't know if I really kind of trust this. The sector rotation. Again, when we are strong and we're in a good bullish intermediate run and we're starting a multi-month rally, these are the three areas up here that we expect to lead us up. And discretionary looks okay, dark green shading the green line, but not technology yet because it went so parabolic. It's kind of hard for it to get going again. And the communication services is like energy, dark pink shading in a red line. So it's struggling. You have industrials, you have financials that are trying to get going too. That's the new leadership right now. And then you can see everything else. And the most bullish chart on here, as of right now, looks to be utilities. And I don't know if we want to ride that horse up to new highs in the broader market, as that's not your typical bullish leadership. So, and really for that matter too, with yields rising, it's kind of surprising that they're doing so well. Because usually they underperform when yields are rising. So I don't even know how bullish that is, considering the macro, the yield environment, that the interest rate environment that it's very sensitive to. So just keep in mind, from a sector rotation standpoint, it's not really confirming this recent strength over the past couple of weeks, and suggests that we might be able to fade this rally, so to speak, as we make another leg lower here. Potentially after this October expiration, but like we saw in November 16 election time. But then over those couple of weeks heading into the election, things can get a little dicey. I think that's what our higher volatility is telling us, and I think that's what some of these strange moves in these different sectors may be telling us as well. And that brings us to our trade idea of the day. And again, the idea is, if we do expect some downside, we got to make sure that we make some trades that have good margin of safety, that don't have a lot of room on any kind of volatility that can wreak havoc on our trades. So one of the stocks I wanted to take a look at for today's trade idea is Clorox. You can see it's had its pullback, right? It's been dark pink shading in a red line more than any others. It's pulled back to its 38% retracement level of its intermediate run that was long-lived. In fact, there's the COVID pullback, the COVID spike, because it's Clorox, and then the COVID pullback, but then you never did get dark pink shading with the red line. So this was really one big, long intermediate rally, and we retraced down to the 38% retracement. You also notice that there's some pretty decent support from a volume standpoint, as well as the big volume node there, as well as the top of this 1-year value area volume. So really good support. It looks like it's working to get up above that 23% retracement and potentially back above the Bollinger Band. It's getting, after being in the lower half of the bandwidth, here's our first breakout through at least to the upper half of the bandwidth. You look at some of these other oscillators, like the RSI and CCI, and you got a good breakout above 150 on this TCI and above 50 finally on the RSI. And you look at the DMI here, and the negative index has dropped down pretty low, below 20. But after all this pullback, this is the first time the positive index has jumped as high as it is, getting above 25, not quite above 30 yet, but at least getting above 25 with this big sharp drop in the negative index. So pretty bullish pattern on this with very good support, so that down in this area here. So very good margin of safety. If we do get some weakness, we're not expecting it to fall off a cliff. MACD is rising, stochastics is rising into the upper half of the chart. MACD is close to crossing above zero. Rising histogram here, getting above the 17-day moving average for the first time in a long time with this move, as well as getting above the 30-day moving average. So nice little opportunity, but again, not too bullish because of the opportunity for it to continue to go higher. So what we decided to do was do a bull put spread, selling the 210 by the 200. Here's the trade here. Selling the 210, there's my short strike. So anything above that I make the $370 that we end up getting as the credit. Of course, if it goes down, now there's really strong support right here, right? So, that this 205 level, basically 210 down to about 205, 200, there's some very strong support right here. So I'm okay if it pulls back a little bit, as long as it eventually comes up and stays above 210 by the time all is said and done. So that's the idea behind this trade, and this type of trade has been working out very well for us into October expiration. A lot of our trades are going to be closing near their maximum gains, as well as the trades we did in our class portfolio for directional option strategies. It's been the strategy to do for the last little bit. And in this case, even if we start to get some volatility, I think this type of stock would be more immune to it because of its margin of safety, as well as its more safe haven aspect anyway. So there's our trade for today. All right, so that does it for today. As always, you've heard from me. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. All of our subscribers, even our free subscribers, have access to that. So you can ask questions. You can respond to other people's threads. Just open up any new thread there. And let's keep this conversation going in between videos. As always, thank you very much for watching. I appreciate your time here today. Remember to subscribe to our YouTube channel. Hit that thumbs up icon down below. Follow me on Twitter and Facebook. Comment on the video. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.